Hey there, financial explorers. Ever wonder what makes a stock hard to borrow or why some fees to short can be astronomically high? Today, we're diving deep into a fascinating microcap stock that recently popped up on our hard to borrow screener, ZCMD. We're going to break down its unique profile and what its current status might mean in the world of short squeezes. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD logo / text. ZCMD is a microcap stock, and its current trading activity presents a unique puzzle. Looking at the recent data, ZCMD has seen exactly plus 0.0% change today, plus 0.0% over the last 5 days, and a flat plus 0.0% over the last 30 days. This mirrors its volume data showing 0 shares traded today and a 30-day average volume of 0 shares. Yes, you heard that right, 0 trading volume. Despite this apparent dormancy, ZCMD has an estimated float of 1.1 million shares. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow? Geographic cost to borrow explained when you short a stock, you're borrowing shares from a broker, selling them, and hoping to buy them back cheaper later. You pay a fee for this loan, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. If a stock is in high demand to be shorted, or if there's a very limited supply of shares available to lend out, the CTB fee can skyrocket. It can even exceed 100% annually, meaning short sellers are paying over 1% of the share price every few days just to maintain their short position. High CTB signals that maintaining a short position is becoming incredibly expensive. Why this stock is hard to borrow right now. Now, let's talk about ZCMD. Our screener flagged ZCMD due to an astonishing annualized cost to borrow fee of 846.6%. Highlight CTB number, that's one of the highest numbers you'll see. With an estimated float of just 1.1 million shares, the underlying mechanics suggest that finding ZCMD shares to short could be exceptionally difficult, hence the massive CTB. Our internal composite squeeze score for ZCMD currently stands at 42.5 out of 100, indicating significant interest in the hard-to-borrow aspect, but not yet the full picture for a classic squeeze. However, here's the critical nuance: despite this extreme CTB, we're seeing 0 shares available to borrow and, crucially, 0 trading volume. This creates a fascinating, albeit dormant, scenario. Squeeze mechanics explained. Show animation. Short squeeze process. A short squeeze occurs when a stock's price surges rapidly, forcing short sellers to buy back shares to close their positions and minimize losses. This short covering creates even more buying pressure, fueling the price climb further. For hard-to-borrow stocks like ZCMD, the squeeze potential theoretically comes from short sellers being squeezed by two factors: rising prices and the sky-high CTB fees, which bleed them financially every single day. Eventually, the cost or risk becomes too great, triggering a frantic rush to cover. However, for ZCMD, with its current 0 trading volume, the classic short squeeze mechanics are currently stalled. There's no price movement to trigger forced covering, even if the holding cost is astronomical for any existing short positions. Dilution risk check. When we assess a stock for short squeeze potential, dilution risk is absolutely paramount. Dilution occurs when a company issues new shares, increasing the total share count and often decreasing the value of existing shares. Our check for ZCMD found no recent dilutive SEC filings -1/-3/424B within the last 90 days, nor any recent reverse split. This is a clean slate on the dilution front. While a lack of dilution is certainly a positive in a short squeeze thesis, as it means new shares won't flood the market and absorb buying pressure, it doesn't alone ignite a squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what do we make of ZCMD's unique situation? On one hand, you have an extreme annualized cost to borrow of 846.6% and a tiny float of 1.1 million shares, classic ingredients for a hard-to-borrow stock. On the other hand, the complete lack of trading volume and price movement over the last 30 days means that any potential for a short squeeze is currently dormant. The high CTB might reflect the theoretical difficulty of shorting ZCMD, but without any actual trading, there's no pressure cooker building. What would change this narrative for ZCMD? A significant sustained surge in trading volume would be the first major indicator. This could mean renewed interest in the company, or perhaps even existing short positions becoming active. But remember, a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay almost any price to maintain their positions. ZCMD presents a truly intriguing case study, a microcap with an almost unbelievably high cost to borrow, but currently no trading activity. It's a prime example of why you need to look at all the data, not just one headline number, when assessing potential short squeeze candidates. Understanding these dynamics is key to navigating the markets. If you found this breakdown of ZCMD helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know your questions in the comments below.